How's it going? I'm very excited today because we are doing a continuation of something I used to do. Back in the day, I called it the Robinhood Trading Challenge, and it was a way for me to show you through a series of videos my trades and my thought processes behind each trade as I entered them on Robinhood. That kind of died as I switched gears towards more educational content. But now we're back, we're going to revive it, so we're going to bring you in the room so you can see my trades and my thought processes behind each trade, this time with TD Ameritrade. So I got 20 grand queued up here. We're going to enter some trades and I'll give you my thought process and all that. But really quick, I want to say, if you want to follow this portfolio and see all the trades, see all my positions, see my profit and loss, see my progress across time, I highly encourage you to download the app called Iris. And I encourage you to do it through the description below and the link in the description. I'm affiliated with these guys, so I make money as you use the link. So that's why I prefer you don't just run off to the App Store, but it's also pretty dope and helps you keep up to date on everything I'm doing. Pretty soon they're adding live notifications, so you get a live notification to your phone if you want it every time I make a trade. So check it out. Second plug, if you want to buy this pin, it's a pretty dope pin. Also comes with a sticker that's a $100 bill with my face on it, or at least will be pretty soon. Check out Pins by Charlie in the description below. Okay, before we start making trades and stuff, there's a few things I have to say to orient you to how we're going to handle this portfolio. Number one, I'm not going to assume you know everything about Thinkorswim, which is TD Ameritrade's trading platform, but I am going to assume you know a little bit. So if you don't know anything at all, watch the videos in the description below. I have a couple of videos that lay out Thinkorswim in really full detail. In addition to that, there might be a lot in this video that I mentioned that maybe you're new, you have no idea what I'm talking about, like leaps, for example. Check the description below. Anytime you hear something you don't understand, odds are I've already made a tutorial on it and I've put it in the description. So check below. Leaps will be down there as well as a few other videos. I'll also try to remember to link them in the top right-hand corner for you. Okay, now let's orient you to my investment philosophy and then we'll dive in and start making trades. It's changed a lot since the first time I did a series like this. Back then, I was a lot more speculative. It was a lot more high frequency, above the shoulders, like mustard shit. Now it's slowed down considerably. It's a lot more calm. I like to maximize how much money I can make and minimize the amount of time I have to spend thinking about it and worrying about it. I don't want to lose sleep. I like doing other shit. So why not make as much money as possible while spending as little time as possible worrying about it? Some people love doing like calculus to squeeze out a couple pennies of premium. I'm not your guy. Go check out Project Option. That's not me. So my investment philosophy has boiled down and refined into really just a handful of strategies since I first started over the last 6 or 7 years. The three strategies that are going to be really the focus of this portfolio are these. One, long-term investing. I highly encourage anybody who wants to trade or is trading to have the majority of their position, at least half of their portfolio, in long-term investments. Now, that's just my opinion. You obviously don't have to do it. I'm not telling you what to do. That's my opinion. If you have a large position in long-term investments, it's going to be like this compound interest engine that is always driving your portfolio in the upwards direction, no matter what you're doing with your speculative positions. They're going to hedge against your speculative losses, and they're going to amplify your speculative gains. Plus, it relieves a lot of stress because, if you make a mistake in your speculative positions, you're probably at least recouping some of that with your long-term positions. So the goal of the speculative is to have higher return than your long-term investments. But of course, those positions, those trades are riskier, so they have a higher potential for failure. And if you fail, you want to make sure that you're still making money. And to do that, you have a lot of money in long-term investments. So one is long-term investing. Two, leaps. Leaps are going to be our bread and butter, and they're going to be what we utilize to leverage our portfolio in the upwards direction. It's important with leaps that you have money to average down in case things go really against you. They're actually not much riskier than owning 100 shares of the underlying stock, but you want to make sure that you can average down if things go really against you. So we'll talk a lot about that as well when the time comes. And lastly, our third main strategy is the wheel. And what I've kind of discovered is that the wheel strategy is best utilized when you're running it on margin. What I mean by that is when you used up all your buying power and then you sell a cash secured put. What happens is your brokerage actually doesn't take any funds for collateral. Normally, when you sell a cash secured put, they'll take enough money to buy 100 shares at the strike price in case you get assigned and hold it aside as collateral, and you can't touch that money until your cash secured put is either closed or assigned. If you use up all your buying power first and then sell a cash secured put, it's actually not a cash secured put, it's a naked put. So they don't hold any money aside for collateral, but if you get assigned, they will use your margin to buy the shares. But the whole time that you have the cash secured put open, you have no money locked up as collateral. So the real benefit, the best time to utilize the wheel strategy is when you're running it on margin and when you're selling a naked put, which In this case, it's basically a cash secured put, except for when you get assigned, you're going to use your margin to buy the shares. So those are our three main strategies, and they're going to be the main things that are running this portfolio. And you'll see that it's actually super easy and we'll be making money. It's going to be great. Unlike other people who love being really high intense and high frequency about things, I do not. I like to be laid back. I like to make money easily, but I like to leverage my positions so I make excessive amounts of money. I'll also be contributing to this portfolio over time. I have the majority of my net worth in long-term investments through M1 Finance, so I want to start spending more money on my active trading. All right, so now I've laid out the whole scope, right? You understand what I'm about, what I'm doing, what this is, yabba doobie dabba. Now let's bring you in. Let's get intimate. Let's actually enter some trades. And we're going to start from the easiest and work our way back to the hardest. The easiest being, let's build up our long-term investments. Now the market's closed in 13 minutes, so we may not get all our trades done in this today, at least for me, but I'll come back around. We'll do leaps and stuff maybe tomorrow. Here are the positions I want to open. So I want 50% of my portfolio, which is $20,000, to be in long-term investments. So I have $10,000 right here. Here are the stocks I want to build into my long-term positions. Tesla, you might be thinking, well, that's pretty overvalued. Why would you want to do that when you wait for a dip? I don't give a shit, because if it dips, I'll just average down. With long-term investments, it's not important that you time it. It's important that you get in, and if things go down and you still believe in the company, you buy more. And with these 5 stocks, I believe in these companies. If they go down, I'd actually prefer it so I can buy at a cheaper price. But right now, let's just get our feet wet. Let's get in. So these are the stocks that I'm going to purchase for my long-term investments. These are the percentages of our $10,000 that we're going to buy. So for Tesla, it's going to be 10% of $10,000, which is $1,000. Microsoft is 45% of our $10,000, which is $4,500, etc. So Visa is 15%, Apple's 20%, and Chegg is 10%. Chegg helped me get through college. I cheated on a lot of assignments. So let's open these positions really quick. We'll start with Tesla, which is $100. So let's go to TD Ameritrade. You can search up any ticker in the top left here, and we're going to type out Tesla. And we want roughly $1,000 of Tesla. So let's open up our calculator. Well, I don't even need the calculator. It's going to be about 2 shares. So we'll buy about 2 shares of Tesla. There's a million different ways to buy stock on Thinkorswim. Let's just choose one and stick with it. Over on the right, we have a trade tab. If we click on that, it's going to allow us to enter market buy orders and market sell orders. And if we click this arrow, we can change the quantity. So I just want to buy 2 of these, right? So let's buy 2. And we're going to change it to market. So once that's ready to go, we just hit buy market. There we go. We just bought 2 shares of Tesla. Now it's a little over $1,000, so we might have to buy a little less than we intended with some of these other stocks. So Microsoft, 45%, $4,500. Okay, we'll buy 17 shares of Microsoft. So when I hit buy market, this window pops up and it's asking to make sure you're comfortable with the trade you're about to open. If you want to send the order faster, enable auto send with shift click. Okay, so if we go back now, if I hit shift and hit buy market, it'll just send it off without asking you to confirm your trade. All right, next is Visa. Okay, we're gonna buy 6 shares of Visa. Bam. Next up, Apple. Okay, 15 shares of Apple. And $1,000 of Chegg. How much money do we have left here? $1,057. 11. Okay, so that was pretty easy, right? All you do is look up the ticker in this box here and then hit trade, so it opens up this window, change the quantity, and send it off. To monitor your orders, go to the monitor tab. And here we can see all our positions, our profit loss so far. Look, we've made $4, so we're already heading in the right direction. Now, when it comes to like all the stuff we're looking on this chart and technical analysis and that kind of thing, we will discuss that in the future. So don't panic. We're just starting with the easy stuff first. You can see in the upper left-hand corner, the cash remaining is $10,000 roughly. So we've used about half of our portfolio for these long-term investments. In our monitor tab, where we're located right now, looking at all our positions, I don't like that they're not grouped together, because tomorrow we're going to open up some leaps, and shortly after that we'll be doing the wheel strategy. So I want all those trades separated by those categories, by long-term investments, leaps, and the wheel. So to create a group, we can right-click on one of these positions, and we go to move to group and add group. So we'll do long-term. We'll hit OK. Now we can add each one of those to long-term. Great, and we can collapse this by clicking the arrow right next to long-term. So that way we can see our profit loss open. I know that's profit loss open because if I unfold, you can see it's under profit loss open. So we see profit loss open and we see profit loss day. Towards the bottom right-ish, you can see our profit loss year to date. You might be asking, Adam, why 5 stocks? That doesn't seem like a lot. You know, most people have hundreds of stocks. Well, for me, there's two reasons why I have such a concentrated portfolio. The first is I want our portfolio here to be very aggressive. I want to try to make as much money as possible. And to do that, that means I have to have a concentrated portfolio. The more I diversify it, the less risky the portfolio is, but I'm also reducing my potential return. So I want this portfolio to be very aggressive, which means I have a concentrated number of long-term investments. And in addition to that, number two, the more stocks you add, the less risk there is, right? There's something called systemic risk, and which is basically just the risk of being in the market. And the more stocks you have in your portfolio, the closer towards systemic risk you are. The second stock you add to your portfolio is going to be the most powerful in reducing your risk towards systemic risk. It's going to reduce it substantially, and the standard deviation of the return of your portfolio is going to be reduced substantially. But then you add the third and the fourth and the fifth stock, and it's going to have diminishing returns, and the reduction in risk is going to be less and less with each additional stock. Meanwhile, the whole time you're adding stocks, you're going to be reducing your potential return. So no, 5 is not the optimal number of stocks. It's argued between 10 and 30, some people think, based on one study, and then another study says, no, not even close, it should be 30 to 100. I don't care. I'm going to be really aggressive. I'm going to do 5. So I'm reducing my risk substantially. It's way more risk averse than just one stock by a long shot. But it is also still very, very, very aggressive. Which means we can potentially have a very, very high return. Okay, that's it for today. I wanted to get this portfolio moving, and tomorrow, which will be literally probably 10 seconds for you right now, I'll come back and we'll be doing some leaps and maybe get started on the wheel. All right, today we're going to open up some leaps, and if you're not familiar, I'll try to remember to link a video explaining leaps in the corner. If I've already done that, maybe it won't pop up again. It's definitely in the description below. But leaps are long-term anticipation securities, or in this case, options. And that just basically means that they're deep in the money and they have a far-out expiration. When they're deep in the money, that's going to lower your break-even by expiration, so the stock price doesn't have to go as far. Theta is not that big of an issue. The extrinsic value of the option, the time value of the option, is pretty slim. So you're not giving a lot up as time passes, and the stock price doesn't have to go as far in your anticipated direction for you to reach break-even by expiration. And having a very far-out expiration is going to give you a lot of time to be correct, so you're not trying to beat the buzzer. Of course, today we're going to be opening leaps that are calls because the stock market generally goes up. Why would I hinder myself by trying to anticipate the long-term downtrend of a stock that has good options volume? That basically doesn't exist. You're more likely to be right betting in the upwards direction of any given stock at random than betting on any stock going down. So because the stock market has an overall upwards trend, why would I not just bet to the upside, especially when we're talking about the long term specifically? Okay, so if you need a refresher on leaps, check out the video down below. And before we dive in, I just want to say all the stuff you see on my chart, all the lines and stuff, this is all used for technical analysis. We may not talk about it too much today, maybe a little bit, but we definitely will down the road in future videos. So if you want your layout to look exactly like this, go to the description. I've linked it down there for you because I'm such a nice guy. You can literally open it up into Thinkorswim, and then once you have it opened up into your Thinkorswim, you want to save it. And to do that, you go to Setup in the top right-hand corner and select Save Workspace As. And once you do that, you can always load it up. So mine's named Default, and I can always load this layout. Once you have one selected, it should always load up into this layout every time you open up Thinkorswim, so you shouldn't have to load it manually every single time. Okay, so let's talk about my thought process when opening leaps. First of all, I'm not the type of guy to scan for stocks based on like 52-week high, 52-week low, momentum, volume across the entire stock market. That's not me. Day traders have to do that all the time because they always have to find unique opportunities. If there are a little handful of stocks that they know just aren't moving that much, then they just can't make money. You have to have a highly leveraged positions as a day trader, and you have to leverage those into bigger swings. So you always have to be scanning for new stocks. Me personally, maybe it's just a fault of mine. I don't do that. I don't scan for new stocks all that often. I might find new ones on Seeking Alpha or like Bloomberg or Twitter or wherever I might see it, Reddit. But I don't intentionally go seeking out new stocks because over the last 5 or 6 years, I've cataloged probably over 100 stocks in my noggin that I already know and can go check out. And I know these stocks are pretty heavily traded, which means they'll have good volume and liquidity, and they'll also have good options liquidity, which makes it easier to open options positions. I don't want to scan for new stocks when a lot of stocks don't even trade options, and if they do, they're usually pretty illiquid. So I've cataloged, the first 50 or so that popped into my head yesterday, just back to back, and I put it into a watch list. You can make your own watch list by coming to the left here, clicking on this drop down and creating a watch list there. Now I'll share my watch list in the description below, and I'll be sure to add more probably today and tomorrow. So that's a nice, robust, full watch list full of pretty heavily traded stocks. Okay, once you have your watch list selected, when you go to personal and you select your watch list, you want this number 2 or whatever it is, to also be the same up here. So let's change this to the yellow number 2. What that means is whatever stock I click in my watch list, it's going to pop up in the chart. And I can use my arrow keys to go down through each watch list and just manually take a look and see what's happening. But that's not what we're going to use it for. We're going to search for a few important characteristics that LEAPs need to have in this watch list. So we're going to search for good options liquidity, options volume. We're going to search for low implied volatility, because remember, it's good to go long options in low implied volatility environments. Implied volatility has a mean reverting characteristic. So if it's low relative to its history, the historical implied volatility, it will be inclined to move back up towards the average, towards the mean. As that happens, your options premium is going to inflate, because implied volatility is implied by an inflation of options premium. So as extrinsic value increases, the implied volatility metric that you might see on a chart, graphed on a chart, is extracted from that expansion in extrinsic value. So as implied volatility goes up, that means that your options premiums are inflating, so you can make money that way, as well as if the stock goes in your anticipated direction. So we want to buy in low implied volatility environments. So we're looking for options liquidity, low IV, and we want the stocks to be kind of cheap as well. The reason for this being is you might have two stocks. You might have Tesla, very expensive stock. You might have AMD, relatively cheap stock. They might have the exact same implied volatility metric of 28%, an implied move of 28% over the next year. If this is all Greek to you, I highly encourage you to check out the options tutorial up in the corner. But they might have the same implied volatility of 28%, but 28% for Tesla is a much bigger dollar amount than 28% for AMD. And because options premium change is based on dollar amounts, not percentages, a 28% move in Tesla is a lot larger than 28% move in AMD. So extrinsic value is going to be much, much higher. Options premiums only care about how many points change over the next year. They don't care about percentages. Points are what impact an options value. So we want to find cheaper stocks because I only have $10,000 to play with. Cheaper stocks are going to have cheaper options. I want to be able to diversify amongst a good handful of LEAPs. So to scan for all these metrics that we're talking about, we're going to go to the Scan tab, and we're going to close out of all of these characteristics we're looking for. So we hit these X's on the right side, bam, 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 they're all closed out. We're going to add some new ones. But first, we want to make sure that we're scanning in our watch list and not all stocks, although you definitely can. I just think it's better for me personally to scan through stocks I'm familiar with. So we click on this guy, go to personal, and then main is my watch list. And we want to, under all of the following, add a filter. The first one's going to be for cheap stocks. So we want the last price of the stock to be between 0 and 100. Okay, and if I'm going fast, remember, you can always slow me down. YouTube has that little cog in the bottom right where you can slow me down, because I don't want someone going, "You're going way too fast, dude," when you can literally slow down how fast I'm talking yourself. Okay, the next one we're going to do is options liquidity. So we're going to add a filter. It's going to be option, and we're going to be doing volume. We just want some liquidity, okay? We're not looking for insane amounts. We can determine the level of liquidity once we narrow it down to a few stocks we're interested in. So we'll do 50 min, and then maximum is whatever number that is. And then we'll add another one, add filter, and we're going to do study. And it's going to be under volatility and IV percentile. So IV percentile is the same as IV rank if you've heard about it. It's a number between 0 and 100. 0 to 50 means that the stock's implied volatility is relatively low compared to its historical implied volatility. So we want to be long options. 50 to 100 is relatively high compared to its historical implied volatility. We don't want to be long options. So we're going to search for 0 to 50. Okay, and we hit scan in the bottom right-ish. And here we have a nice list of stocks. Now you won't see IV percentile listed in any of these columns unless you go to this tiny, tiny little cog to the right. Click on it, customize, and then search up IV percentile. And we hit OK. And on the right, you can see IV percentile. So we're going to sort from lowest to highest. And you can see there's some good ones like Alaska Air. That might be a good LEAPs play. NTNX, not so sure about that one. I've already looked through these a little bit. But AMD, I chose AMD and Activision yesterday after looking through some of these, just because those are the stocks I'm most bullish on, and I know will probably have higher options liquidity than some of the others. You know, if you look at any of these companies and you're like, man, I really like this company. I just like the company a lot. I would use their product. I do use their product. I understand how their business works and how they make money, and I see their potential. If you're into a company for the long term, that's a company that's great for leaps. The important thing about leaps is that if things go against you, that you're able to average down. You're able to open up a new leap using margin or your own cash, or open up 100 shares of the underlying stock to recoup your losses from the first leap that went awry. And we'll talk about that later. But if you are, anybody can make money in long-term investing, and you can carry that over to leaps. Anybody can make money in leaps over the long term as long as they're willing to average down if the leap goes against them. So if you see a company and you're like, I really like that company, that's basically all you need to know. If you think that it's a popular company, good growth stock, whatever, as long as it has good options liquidity and you have the balls to average down when things go really, really against you, and you can handle that, like putting more cash into your account, which I personally can, then leaps are a great option. So don't get tied up into like really nitty gritty, like what are the fundamentals as long as they're making money? And what does the chart look like? Maybe the chart can help with timing, but if you like the company for long term, that's basically all you need to know when you're picking your leaps. Leaps is actually kind of singular, long-term anticipation security. So it's, when I say leaps, I'm not being stupid. Anyway, I'm really bullish over AMD and Activision for the long term. So let's go to charts. This is where we originally entered our stock trades yesterday, but this is not where we enter our options trades. We want to do that in the trade tab. We also want to change this number to the same number that's in our charts tab, which is the number 2 yellow, so that when we change the stock over here, maybe we change it to Apple. We go over to the trade tab, it's also going to change it to Apple. We don't want those two to be different, otherwise we might accidentally open the wrong option. So once those are the same, let's go back to AMD. With the leaps, you want to pick 9 months or more out, generally speaking. The further out, the less liquid, so it might be harder to get in. But over time, they'll become more and more liquid as the expiration nears. The closer the expiration is, the more liquid the options are going to be. But you also have to be a little bit careful, because if your option gets very, very deep in the money, the deeper in the money it gets, the less liquid it gets as well. So you may end up over time with an option that's super liquid that you could maybe not even sell. That's entirely possible. So you either, one, want to keep a good lookout and always be watching your options liquidity, and also the liquidity of options that are deeper in the money, because those are going to be less liquid, and that could be where your option is going to end up in the future. So you want to check and make sure that your option and the ones slightly deeper in the money are still looking good, still looking liquid, or you want to be willing to exercise at some point, which means you have to have the margin available to exercise or the cash available to exercise. And yes, with leaps, you may want to exercise if things get too illiquid, even though most of the time you don't, because you give up extrinsic value. But with leaps, extrinsic value is so small that it may not be a big deal. And you might actually end up making more money through exercising than selling at a really horrible price just to get out of the trade. Okay, so it's April, so our options basically are under the expirations of January 2022 or June 2022. January is going to give us a good 9 months. June is going to give us much longer than that. And the June ones are going to be slightly more expensive as well. And we can kind of compare that here. So if I unfurl the June expiration options and the January expiration options, we can compare the prices. So on the left side, what we're looking at are calls, right? Here are all the strikes, 80, 82.5, 85, 87.5, and these are all different call options right here, each one of these rows. So if I look at the 80 strike call, you can see that the premium is somewhere between 1340 and 1365. All right, that's a pretty nice tight bid-ask spread. This is kind of close to at the money, so it's not too surprising. If I go down to the next expiration, the June one, another 6 months out, you can see that's roughly $300 more expensive, but the bid-ask is still pretty tight, so these options are fairly liquid. So we're going to pay an extra $300 basically in time value in order to push our expiration out by 6 months. It's not really that bad when you consider what we're basically doing is trying to get the leverage of 100 shares into a cheaper position. It's a reduction in buying power, but a similar leverage to that of 100 shares. The extra money you're risking is going to be extrinsic value. Again, I highly encourage you to watch my leaps video because I explain this in great detail. Now, we'll get into more of this in just a second, but let's change the layout of things, because right now we just see like the asking price. If we follow this down, we see the asking price of each option, the bid, net change, and last traded price. I don't care about any of those, so I want to change this up. So go to, well, I do care about the bid and ask, but not the other stuff. So go to layout. We're going to customize. I don't care about these two things. You can double click them to get rid of them. Here's what I do care about. I care about delta. I care about theta, vega, volume. It's going to help us determine options liquidity, open interest, number of contracts currently open at the moment. And I also care about extrinsic. We can actually see extrinsic value, so we can see what we're paying for a time premium, how much more we're risking than if we had just owned 100 shares of this stock. So let's hit OK. So here we have everything laid out. You can see the extrinsic value. If you follow this column down, you can see how much premium we're paying just for time. And we're looking at the money options, which have really high extrinsic value. You can see the majority of the premium, about $14 of almost $15 of premium, is for time value. And you can see that the option is trading at 15.10 and 15.65. So almost the entire options premium is just for time value, and that'll decay across time until the extrinsic value is 0 at expiration. Let's see more strikes and see if the in the money options have less extrinsic value. So we're going to change strikes from 4 to all. So you can see as you get deeper in the money, you can see this column extrinsic value decreases. And that's the case as you get away from at the money in both directions. The further in the money you are and the further out of the money you are, the smaller the extrinsic value is. So generally speaking, when I'm looking at leaps, the first thing I look at is delta. I generally open a leaps option between a 0.8 and a 0.9 delta. It gives me a good starting place. Then I can evaluate the liquidity of the option as well as the break even and see if everything there I like. Otherwise I can change the strikes a little bit, and maybe even if it's just not looking great, I can change the underlying entirely. Okay, so we're going to look at this option as a 0.3 delta right there. If we follow it over, you can see that the extrinsic value of this option is about $3 in premium. So that's $300. So that's the extra premium we're willing to risk as compared to just owning 100 shares of the underlying stock. But by expiration, we're going to have the same leverage of owning 100 shares of the company with just this one option. Before expiration, that's not the case, because as you get away from at the money, extrinsic value shrinks. So that means the premium of the option shrinks. So you don't have a 0.1 delta. If extrinsic value didn't change when the stock price changed, then you would always have a 1 delta with any option. But because extrinsic value shrinks, meaning your options premium shrinks even as delta makes you money, that's going to mean that your delta is not going to be 1. So you don't have exactly 100 shares worth of leverage until expiration day when extrinsic value is gone. Therefore, extrinsic value can't change. So your delta is going to be 1 at expiration. So this price tag, this 343, is the extra we're risking as compared to owning 100 shares for leverage very similar to that of 100 shares. Okay, but how much money are we freeing? So we're risking $343 as compared to owning 100 shares. How much money are we freeing up by using the leverage of an option instead of buying 100 shares outright? Well, if you look at the current stock price of AMD, which is 83.07, and multiply that by 100, it would cost us $8,300, sorry for my bad handwriting, and $7 to buy 100 shares of AMD. But these options only cost about $2,500, less than $2,500. So we're using basically like a quarter of the buying power to have similar leverage as $8,000, while risking only an extra $343 that I think we can make up by the $6,000 that we're freeing up to use elsewhere. Do you think we can make $343 off of $6,000 over the next 9 months? I bet so. And you can also see that these options are relatively liquid. Even though they expire 9 months from now, they have an open interest of 617 and no volume. And no volume is generally considered like, oh no, bad, but it's actually not a big deal because expirations that are way out there, there's not many people trading them on any given day. And volume is just the number of contracts exchanged today. So even though there's 0, that's not a big deal. What I really care about is the bid-ask spread. Are there market makers there providing liquidity? And is there open interest? And the fact that this open interest is on an uneven strike means that it's going to have less. So I would recommend that we probably move it either 1 point more in the money or 1 point further out of the money. I'd rather do 1 point more in the money, because if I erase the circle here, you can see that 1 point in the money is about $300 of extrinsic value, and the price of the option goes up by about $200, which isn't that big of a deal. Okay, so we started with around a 0.8 to a 0.9 delta, somewhere in there. Then we take a look at extrinsic value. How much extrinsic value is there? Is how much money we're going to lose if we hold this option to expiration? How much is going to decay across time? And also extrinsic value is going to determine your break even. Your break even is premium strike price plus premium paid. The higher your extrinsic value, the higher your break even is going to be. So we want that to be nice and low. And we also want theta to be low, which means the money we're paying to play each day is going to be low. And for it to be low, that means our extrinsic value has to be small, because that is a portion of the premium that decays across time. If extrinsic value is small, your theta is going to be small. If extrinsic value is large, your theta is going to be large. So we took a look at extrinsic value to see how much more we're risking versus owning 100 shares, and to make sure that our break even is going to be low, which we'll now analyze here in a second, and to make sure that we're not fighting theta the entire time, that we can make money easily as the stock price rises. Then we took a look at options liquidity to see the bid-ask spread. In this case is about 1 point wide, which isn't that big of a deal for an expiration that's 9 months out. That'll decrease as we get closer, as the expiration gets closer to us. Front-month options are going to be more liquid versus options that expire 9 to 12 months. I mean, you can see this is a 62.5 option. The bid-ask spread is about 1 point wide. If I go to a closer expiration like June 18th and go to the 62.5, and I go to 62.5, you can see the bid-ask is only 20 cents wide, so it shrinks a considerable amount by like 75%. 80%. But we also want to analyze and see what happens if the stock price goes up, if this option starts going deeper in the money, because that's going to reduce liquidity. Well, if we look at these options, you can see liquidity gets, a little worse. This one's like 4 points wide. That's not great. But we also have to consider that the deeper in the money it's getting, the more time is probably passing. So we want to take a look at expirations that are closer to us and analyze the liquidity of options that are deeper in the money at those expirations. So for example, we might go to September and look at the 50 strike and see what the liquidity is. It's less than a point wide. So that's great. That means as time goes on and as our option comes deeper in the money, liquidity is still going to be good. So the last thing we want to take a look at before we open this option is what is the break even, and we'll look at the chart and see if it seems like a reasonable expectation for the stock. So break even is strike price, which is K plus call premium. So in this case, we're going to move it up by 1 strike because it's going to be slightly more liquid, which is a 60 strike. So we'll do 60 plus, and we'll guess that we're going to get a fill somewhere between the bid ask, which would be 26.40, which equals 86.40. So we can come over here to the chart, and if I hit my middle mouse button, I can select price level. Okay, we're going to use that to help measure here in a second. Our break even is 86.40. So we go down on the right hand side, you can see the stock price. It's going to be somewhere around there, and then we hit our middle mouse button again, select this line, this trend line, and we're going to go to our expiration. So our expiration was what? January 2022. Okay, so we're there. You can see the date on the bottom. We're going to click here and just go straight up. Hit the middle mouse button again, select a circle. We're going to draw a circle around it. Okay, that's our break even. That seems like a reasonable expectation for AMD to hit that point by expiration. And you have to remember, break even rises across time as extrinsic value decays. So right here, your break even is going to be right where you started. But as we approach expiration, your break even is going to slowly rise. And then the last 30 to 40 days, it's going to rise pretty quick as extrinsic value decays exponentially within the last 30 to 45 days. So this is a reasonable expectation, and if things take a pooper, no big deal, because I'll just average down. The benefit of owning a LEAPS is that if things go down really, really bad, and your option becomes worth a penny, if it goes down further than that, you're not going to lose any more money. If you're owning 100 shares, you would lose money all the way down. So LEAPS actually kind of protect your downside a little bit if things go really, really against you. Because you can't lose more money than you put into it. And if you average down and buy new LEAPS and wait for the stock to recover and start moving in the upwards direction, or maybe you just want to buy 100 shares so you don't have to worry about expiration, or you just don't have the money to keep recycling LEAPS into it, then you can just wait for the stock price to rise and recoup your losses just as you would with long-term investing. Okay, so all this seems fair. I think that's a reasonable expectation. We could wait for a better time, perhaps. Maybe this will zigzag a little bit and start moving in the upwards direction. Maybe that'd be a bit of a smarter idea. But I'm ready to get some skin in the game, so let's go ahead and do it. So we'll go to trade, the trade tab where we were just a second ago. And we're going to be doing the 60 strike call. Okay, make sure we're under calls, right? Call right there. And we're on the right expiration. Make sure we're at the right strike. And we can select the ask price. That means we're going to want to buy. When you hit the ask price, that means you're buying. When you hit the bid, it means you're selling, right? When people want to get immediate fill and they're buying anything, stock or option, they're going to buy it at the asking price. So if you hit the ask, it's going to assume you want to buy this option. It's going to pull up this trade window towards the bottom. Let's work our way from left to right. So we want a single option. We're buying it. Our quantity is just going to be, well, actually, we'll do 2 because they're pretty cheap. No, we'll do 1. We'll think about adding another one maybe in a little bit. Expiration is 21st January 22. Yep. Strike is 60. Call. Yep. Now, price. This is where I like to negotiate. Okay, this is where I haggle. I don't just give the asker what they want. I want to put it in the middle of the bid ask or even cheaper and hope the stock comes down to me. Something that's helpful is we can go to charts, go to our time frames in the top right, and switch to 5-minute. Now we can see what the trend is for AMD on the day. It seems like AMD has kind of bottomed out a little bit right after open, launched up into the stratosphere. Now we're having a little bit of a trend change, and you can kind of feel that when you look at the stock chart, right? Ignoring all the lines and stuff, you can feel the trend changing a little bit. That doesn't mean it won't continue up. It could totally continue up for the rest of the day. AMD's, people love the stock. More than not, it's going up. But you can see kind of a trend change. It's kind of topped out here. There's some resistance, which means there's more supply around this price level of around $83. More people are selling up there than are buying. So every time so far the 2 times the stock price has hit it outside of pre-market, it's bounced off because there's a level of supply. People don't want supply overwhelms demand at that price level. And you can see that has happened twice, and you can see the trend changing. It went from higher highs and higher lows, and now it's starting to shift to what looks like perhaps maybe lower highs And we don't know about lower lows yet. Well, a little bit of a lower low there. But I imagine over the next hour or two, we'll see whether or not this trend is actually developing in the downward direction. But this is enough of an indication that maybe, you know, we can get a more fair price for this call option. As the stock goes down, if this is an actual downtrend forming here, and it goes down across the day, the value of the call option is going to decrease. And as it decreases, that means we can get a cheaper fill. So we can set a limit order below the bid-ask spread, hope that AMD goes down in the day so that the price of the call option decreases to the limit price we set, and then we'll get a fill. Now, a good way to determine what points your option might hit a certain price, depending on what, you know, the stock price determines what the option's price is going to be. How do you estimate what what stock price is going to be where your limit order is? Like if I set a limit order for 290, where does the stock have to go for the option to hit 290? Well, a good way to do that is using the option profit calculator app. It allows you to see what your potential profit and loss or the value of the option would be across time given different dates. It also allows you to see your break even on any given day. As we discussed, we have a quick formula for break even, which is strike plus premium paid, but your break even for each individual day is going to be different than the break even on expiration, which is typically what people mean by break even when they're talking about options. So option profit calculator, the app, allows you to see your break even on the current day, which is really handy to see how far away you are from your goals. I highly encourage you to check it out because it's mobile. You don't have to use the options profit calculator online because that's a little bit clunky, not as modern, and you can't carry it around in your pocket as easily. So we're going to go back to the trade tab, and we're just going to set a limit order that's somewhere below the mid price. Okay, we could look at the daily chart and be like, well, look, it's been, you know, up, down, up, down, up, down. It's having this mean reversion over and over, where the mean's somewhere in the middle here. Okay, and every time it goes outside of the average, it returns back to it. So you might think it might come back down, and we can set a limit order much lower than where it is right now. But we're not going to do that with this one. I just want to get my skin in the game. I'm not trying to guess too hard. I just want to get a slightly better deal. So let's go to the trade tab. We're going to, down here in the bottom right, we have the mid price, which is the middle of the bid ask, and then that price, which when you're buying is going to be the asking price. When you're selling, it's the bid price. It's the price where you can get an immediate fill. So let's drag it over to the mid price, and we'll lower it by probably 20 points. So we're going to try to save 20 bucks here. I just don't want to wait too long. So we'll set it to 26.10. I also forgot that you can see the expected AMD price for your limit order. So in this case, it says 83.04. So if we go to our intraday time frame again, we can see that we'd probably get a fill around here. Okay, and that seems fair. It's fair enough to me. It could definitely take a leg down to that point. So let's go ahead and set it for 26.10. Oop, the mid price changed. This is why I always want to set it lower. So let's move it down even further. Okay, so you can see that leg down is actually starting to develop a little bit. If it breaks this point right here, it'd be probably a good indication of a downtrend, but we're not going to wait that long. So let's just do the mid minus 20 cents again. You can see it's always a little bit clunky, but you can always get it. The expected price is 82.45, so let's remeasure that. That's a little low for my liking. I'm going to move that up a couple points. You know what? I'm going to leave it at the mid price there. I think the mid's fine. The expected AMD price is 82.69, which is all the way down here. But that's also assuming that that it's the asking price is going to be there. Okay, so right now if I enter the mid price, I'll probably get a fill immediately because these options are pretty liquid. So let's just move it down 10 cents from the mid price. Try to get squeeze out an extra 10 bucks. Okay, so once you look over all this and you see that it is good, like God created this, then you're going to hit confirm and send. It's going to bring up a dialog window, making sure you know what you're doing, making sure everything looks good. And once you've analyzed all this and decided, yep, this is exactly what I want, then you can hit send. Now, we didn't get a fill immediately. You would see a little window pop up if we had gotten a fill. But we didn't. But we can see over in our monitor tab, under AMD, we have a call there. But you can see under quantity, it's 0, so it's pending. If we want to see our working orders, you can see it under today's trading activity. Just unfurl this drop-down window, and you can see our working order. If we ever wanted to cancel this order, just come here, right-click it, you can cancel it, or you can cancel and replace, which will bring up this dialog box so you can change the price, change the strike, whatever you want to do, and then you can send it off again. So it'll cancel and replace the order that you had to send off. We're not going to do that, so we'll hit delete. That'll leave our trade still open, and we'll wait for a fill. Now let's do the same thing really quick with Activision. I'm not going to drag out too long, otherwise Eric's going to kill me because I've been filming for 37 minutes. So let's go to Activision really quick. Let's see here. So we got January 22. There's no expiration between January 22 and January 23, so we're going to do January 22. I don't want to hold on to an option for that long. And we're going to go to a delta around 0.9 0.86. Let's see here. Liquidity is looking okay because the bid ask is 1 point wide. Let's check. This is for the 70 strike. Let's check closer expirations. So we'll do August of 2021. 70 strike is 15 cents wide. Okay, but how about deeper in the money? Because what happens if our option gets deeper in the money across time? So let's go deeper in the money and take a look. Yep, the bid ask is still really tight. So as the expirations get closer, you can see that liquidity improves. So we're not too concerned about liquidity here. If things got really bad, we could always exercise, give up the extrinsic value, as long as we have the margin or cash to exercise, to buy 100 shares at the strike price. So 70 is looking good for liquidity. How about extrinsic value? So we look at extrinsic, that's 100 points, 1 point in extrinsic value, almost 2 points. So almost $200 we're willing to risk in excess of owning 100 shares. Theta's going to be low. Our break-even is going to be relatively low. We could lower our break-even even further, but let's take a look at the chart really quick and see what the momentum is behind Activision, see where it's heading. Okay, so right now it's having a bit of a pullback, and I wouldn't be surprised if it continued pulling back a little bit before continuing the upwards direction. So I kind of want to have a lower break-even just to reduce any potential losses if things go down considerably. At least my break-even will be lower, and the stock price won't have to rise as far for me to break even by expiration. So let's go a little bit deeper than 70. Let's go 65. We're going to do, we'll do 65. Okay, now let's analyze the break-even price of that. So we'll do strike plus premium paid. So for 65, it'd be 65 plus somewhere around 31, which is going to equal 96. So we can come back over to the chart, open up, hit middle mouse button price level. We want to go to 96, just right about there. If you want to make it super accurate, you can hit middle mouse button, select your selector, and then double click the line, and you can change the exact price. So we can change this exactly to 96. Then we want the trend line, and we're going to go to our expiration date, which is January 2022, about right there. So our break-even's right there. That's not very far up from where the current stock price is, and we have a lot of time to get there. So that's looking pretty good. How much money are we saving as compared to buying 100 shares of the underlying? Looking at the 70 strike call, we're paying about $2,700 for it. Okay, so we're going to end up paying around $2,700 to own 100 shares of Activision right now. It'd be 100 times the current price of $94.86, which would be $9,486. So you can see the price difference, the amount of buying power we use for this option, which will have the same leverage as 100 shares at expiration when its extrinsic value is decayed, is much, much less than buying 100 shares outright. And as long as we have the ability, the margin or the cash to deposit into our account to average down if things go really against us, it is not much different than long-term investing, except for the fact that you're giving up extrinsic value. That's the extra you're risking on top of, or versus holding 100 shares. So huge reduction in buying power there. So let's go ahead and open this one up. You can see it's less than a point wide on the bid ask. We already checked the liquidity, I guess. You can see there's some open interest. That's good, and some volume as well. So we're going to hit the ask. We're going to change the quantity to 1 for now. Everything looks good, and we're going to change it down to the mid price. Now we can come to Activision and look at the intraday and see if we can squeeze out a few extra pennies. You may want to look at the daily and just see what's, even now we could set a limit order way, 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 way lower and wait for days for a fill. But I'm just ready to get in and get going so you guys can start seeing my trades on Iris. Maybe I'll set some lower limit orders. I'll open some more leaps, maybe on Activision AMD again, and maybe some other underlyings with much lower limit orders in anticipation for a small correction on some of these stocks. So we'll go to intraday, and you can see that it's already pulled back pretty significantly. This is definitely an indication that there could be another leg down, but at the same time, it's also pulled back quite a bit, 1.68%. So, any move down probably wouldn't be that substantial. I'd probably just get in at the mid price for this one. Again, to be fair, this is pretty bearish to have a very long downward trend and then a sudden sell-off like this, and then some consolidation where people are exchanging hands, whatever, but there's no big bounce in the upwards direction. There's no cancellation of that downward move. There's just some consolidation, and there's probably going to be another downward move after it, but I don't want to wait days for that to happen. So I'll probably enter an order just slightly below the mid price again. I might open ones with limit orders that would take days to get filled, but we won't do it for this one. So we'll do 30.90, and we'll bring it down just by 5 cents and hit confirm and then send it off. We can come back to the monitor tab. You can see both our working orders here, and those will eventually get filled. If you get impatient, just cancel and replace the order, move the limit order to a higher price. You'll get a higher chance of getting filled. Rinse and repeat until you get filled. But I'm willing to wait a little bit to see if I can squeeze out a few extra pennies, but I'll keep an eye on this. Again, if you want to follow all my trades and stuff and everything I'm doing on here, because this is not all I'm going to be doing, this video is just getting too long, you can follow me on Iris, download it through the link below, please, and you can see all my trades there. We are going to be trading the wheel strategy, so I highly recommend you watch the video I've made covering the wheel strategy. It's going to be in the description below. We're not trading it now because I'm moving my margin privileges over from an old account that I had with TD Ameritrade. You can't have it on 2 accounts. And the wheel strategy is best traded on margin. You can actually sell cash secured puts on margin. Really, it's not a cash secured put. It's a naked put. It doesn't require any collateral. No money's being held aside as collateral, but when you get assigned that put, you will use your margin to buy those 100 shares. So it's actually a naked put, but it acts as a cash secured put using margin. So it's not even your actual money. So you don't have to have your own cash set aside as collateral, just being held hostage for long periods of time. Anyway, we're going to get into that in the future videos, which will start next week. But for now, just play around with Thinkorswim if you're using it. And I hope this gave you some insight into how I handle my options trades. And of course, each time will be a little bit unique, and you'll kind of see how my intuition plays into it and all that jazz. Anyways, I'm excited. Thanks for tagging along for this long. I'll catch you guys in the next one.